Because there's one thing, no matter how good AI gets, there's one thing it will never be able to do: predict the future, right? Yeah. And as long as it can't predict the future, you're going to need somebody to make bets on the future. And that requires portfolio managers like us, entrepreneurs, innovators, and a host of other individuals to take those tools and make those bets on the future.
So the hard part is not access to information, it's maintaining discipline. When narrative shifts, the edge is not AI, the edge is structure.
Welcome to the new episode of Brave New Edge. I'm Nikola Legetic, and today we're joined by two investors that have built their careers at the intersection of behavioral finance and small cap portfolio management. We have Mario Tufano and Mark Roach from CS McKee. CS McKee has been long known for its disciplined, kind of research-driven approach to micro and small cap investing. They've been an independent asset manager who've been recently purchased by Azimut, a large Italian asset manager. And what makes today especially interesting is that both Mario and Mark explicitly incorporate behavioral forces into their investment philosophy. Also, as a side note, Mario has written a book that I highly recommend. I consumed it in the form of an audiobook, but it's a page turner. Either way, the golden age of bullshit, we can say it on this call. So, guys, welcome.
Thanks for having us.
Yeah, thanks for having us. It's exciting to be here.
Of course. All right, Mario, let's start with you. Could you just give us a brief overview of your background and what your role looks like at CS McKee today?
Yeah, so Mark and myself, we've been doing this for almost 20 years. I joined him in 2007 from UBS at a firm called Dream and Value Management, which is a really true contrarian investing firm. And that's kind of where both of us really honed our behavioral chops. And from there, we transitioned in 2016 to a firm based in Cleveland called Foundry Partners. They carved Mark, myself, and our team out, which was just our small cap value assets, to complement their portfolio of value products that they're offering. And recently, last year, as well as this year, there were a few transactions that occurred. We, as an entity ourselves, Foundry Partners, joined CS McKee at the beginning of last year. I believe that deal was done. And simultaneously, the entire entity, CS McKee, as well as our North Square, which is our kind of parent company distribution arm for CS McKee and a bunch of our products, joined Azimut, Italian global asset management firm, as of January early this year. So it's an exciting time to be chatting with Mark and myself, not only because we have these amazing transactions that have occurred, but small cap in general is taking a turn and leading the markets for the first time. And God knows what in our careers, Mark. And it's exciting because we do think this is the start of a multi-year cycle here.
Excellent. Mark, maybe just touch on like how your approach to micro and small cap portfolio construction through this behavioral lens, maybe just an overview on the strategy.
Yeah, sure. I mean, just as a quick, who am I and what I do? Yeah, when I started in the industry, I was still a sophomore in college because I could code. My dad, he had a computer back in the 80s in my basement, and before I could play Atari, I had to program a code for him. So long story short, that was how I got in. Then I started spending a lot of time on the fundamentals and doing all the stock picking, and all of a sudden I'm doing back coding. So it's a kind of a 360 comeback. But our process is pretty simple. I think if you look at what we do, valuation, right? We're value guys. One of the things that we look for is to try to apply some sort of fundamental metrics like price to book to ROIC or something along those lines to make sure that we're getting how much are we paying per unit of profitability. The second piece, real quickly, is going to be the momentum, which for us means we're trying, we already know we have a bunch of cheap stocks that we're looking at and we're trying to buy. The next piece is with the momentum is we don't want to buy stocks that have negative momentum, right? It's like that falling knife type of thing. So that helps us avoid those. We put them in a little penalty box, and from there we can move on. But the next piece is quality. And for quality, it's about the returns on invested capital that they're making, right? Are they able to reinvest and get up the same or a better rate of return? Everybody likes a compounder, but it's very difficult to find them. We've had set up some ways that we can actually look at those and see what if they're reinvesting and what that return is. So that's pretty exciting. And then the last piece is the narrative, and that's where a lot of the AI stuff comes in for us as well.
Excellent. Okay. Mario, you have written obviously extensively. We mentioned the book, but you've written in general on kind of behavioral forces in the markets. So how does that actually? And again, I listened to the book, I read the book, but maybe just touch on how does that philosophy, behavioral philosophy, show up in a day-to-day decision making, managing, small cap portfolio.
So you'll be surprised to hear from active managers like Mark and myself that we believe the markets are efficient. And they're very efficient at pricing in the biases of the underlying market participants. So when you think about stocks and industries, they're driven by individual decisions. And those decisions are based upon those individual biases that people have time and time again. And it's been proven and shown over multiple generations and multiple cycles that there are periods and times where people overshoot and undershoot, whether it's a specific industry, whether it's specific stock, due to news that comes into play here. And those biases are best shown within our quantitative front end that Mark just alluded to, right? Those factors that we're pulling on, whether it's value, momentum, quality, and even the narrative itself, it gives us a really good understanding of the decisions people are making. And those decisions, once again, are based on individual biases that time and time again, people exhibit. The only thing that hasn't changed, technology has changed. I mean, there's easier ways to do things, more efficient, effective ways. But the one thing at the core of it is the human component. They're still based upon fear and greed. And again, there are periods of overreaction, periods of underreaction. And our process does a fantastic job in isolating opportunities within that universe, given the biases of the market participants.
Got it. Some of these, Mark, in small cap investing, like some of these inefficiencies are structural, right? Whether it's liquidity, lack of coverage, even some sentiment extremes, because it's usually like a one business, the whole company is just like one business, and it's not very diversified. So maybe like touch on that, like how do these behavioral kind of permanent distortions create, persistent alpha? Like how is it really these behavioral triggers that put things in vogue or something, or is it just touch on the whole thing?
Yeah, so I think we get excited when there's not a lot of coverage on it, right? Those are the types of stocks that we can go in and dig in and find that we obviously the fundamental part of it is still the key, right? When we're looking at the quality of the company, we're looking at the debt, the sales returns, all of that. So all of that fundamental work comes into that space right there. But the thing for us is when we're looking at for behavioral stuff, there's a lot of anchoring that goes on, right? Or so what's happening is they're anchoring on, oh, this company was always a 5% ROIC company, making this up. And all of a sudden they get a new product or something else that is going to drive that forward. We can get ahead of that. So those are the types of things that we like to look for. I mean, we've had, across our periods of time back in the early days, we had Hanes brands that was like a 10 bag. I mean, they sell underwear and t-shirts, right? So, it was kind of one of those things. So, every stock has a story to tell, and we're sitting here trying to figure out what's the story and can we make money with it.
Got it. Yeah, that's for sure. And also, yeah, like back to you don't want to buy a falling angel, right? Even though maybe there's 20 guys covering it, you don't want to name that when there was a mid cap and now it's a small cap. You want to, you want to buy a name that, like you said, nobody discovers, and then that excitement of like, oh well, just 5 guys just picked up coverage in the last 12 months, and it gets introduced to the market in well, maybe to quote unquote lazier investors, but yeah.
Exactly. Well, the liquidity part has kind of, I mean, we've seen low liquidity in small caps, but I would say recently, especially this year, we've seen better liquidity than we have in the past, from terms of people getting excited about small caps again, which is really the key.
Yeah, I think we had a different small cap value manager, and it's they had this chart of the performance of small cap value. They were alluding that it should be right now, right, and or taking place, and then after the call when we spoke, they said like most of the people that are allocating money say like, hey, I really believe in the story, but I want to see that first good year one, and then they want to make sure the party's good before they get in.
Yeah, everybody loves a winner.
Yeah,
Exactly.
exactly.
Yeah.
You're
That's what they
chasing
want.
winners for sure.
That's what they want to hear. They want that story. And that's I mean, think about now what just happened with the AI anxiety earlier this year. A classic example in software. There's this massive concern that it's going to displace all these software companies with these new agentic AI agents that are going out there and doing little tasks and building upon one another. And no doubt there's a story to tell there. But I'm sure you that there are some hidden gems within that, particularly in the small cap world that are getting thrown out with the bathwater. And I think that's when opportunities like that arise, where Mark and myself can step in and say, look, things are a little bit of overreaction here. Let's find the quality companies, unearth them, find out why they don't have, it's a temporary hiccup and not a structural impairment. Let's allocate to them and make some bets along that way. And you see it time and time again. It happened multiple times, whether it was the credit crisis, whether it was post the credit crisis and energy going to becoming obsolete. I think about when I got out of college, 2002, the biggest themes were this. It was the BRICS economy, Brazil, India, China, right? Tech was obsolete because it was the end of the dot-com bubble. And it was peak oil, right? It was a commodity super cycle being driven by these emerging markets. You fast forward 25 years later, 20 years later, and the only story was commodities are dead, going the way of dinosaurs with fossil fuels. And on top of that, tech's the only game in town with AI and Mag 7. And plus, you don't want to invest in international markets, all US based, because that's been the best performer over so long. It's amazing how you see these shifts take place. And again, as Mark alluded to, we're in one of those regime changes now. And I think a lot of that has to do with the AI that we'll talk about here shortly. A lot of that has to do with just over-evaluation extension in the large cap space, as well as the narrative eventually turning and people starting to wake up like, oh, wait, there's something else besides Mag 7. Last year was a big year for that. You had precious metals that blew it out of the international markets were up huge, right? Small caps still lagged and struggled. But this year, and particularly since November, it's showing some real life. And I think to your point, Nicola, if this sustains for the next couple of months and potentially a year, everyone that's been saying they want small cap are going to jump on. Now it'll be 20, 30% higher than where they could have gotten it, but they'll jump on and they'll perpetuate that cycle even.
Yeah, I feel like there's two schools of thought when it comes to small caps. One of them are saying AI is actually evening the playing field, right? So you'll be able to achieve more as a small cap name with a better use of AI. And then the other school of thought is, which I don't necessarily agree with, is that, it's moving so fast and the investment is so high that, that it maybe just the big guys can keep up with it. So do you have any thoughts on that?
Mark?
Yeah, I mean, in terms of what we're seeing are you talking about just like the CapEx that?
No, yeah, I mean, just so if you are a small cap software name with, I don't know, 20 developers and you're competing with HubSpot
Oh,
that
yeah,
has
yeah,
1,000, AI should give you more operational leverage. I mean, in terms of like achieving more with less, right?
yeah. So yeah, so
Evening
I
the
get what you're
playing field,
saying.
right?
So we've seen huge improvements in coding accuracy from AI, especially with 5.2, especially if you're using the APIs and all the other tools that they have on the OpenAI site. Um, they're better at debugging, writing, explaining the code, all of that stuff. But replacing developers, yes, there's going to be less hired, in my opinion. They're not going to be a full swath of 40 developers trying to make this system, because you need to use open or any AI as a force multiplier, right? That's what you're trying to figure out. So you're not going to be writing code, but you're going to be sort of the conductor of it, right? And then you're going to have to use it again, like I said. And in some ways, AI makes fundamentals more important, not less. If you do not understand what the code is supposed to do, you can't evaluate whether AI got it right. So the risk is not that AI writes code, or, the risk is that people accept code that they don't really understand.
Yeah. And just to piggyback off that, I think there's a few shifts moving on here. I don't think you could just put it into a vacuum and say AI is going to do one specific thing. From the looks of it now, it is a threat, an existential threat for some careers and industries. Yesterday, I showed Mark today a website that I put together, a very complicated website. It took me less than an hour of all the work that I've done in the past with my book, picture, YouTube, that's that I've done, podcasts that I've done in the past, and literally something that taken about an hour would have taken weeks upon weeks on end to get a designer and cost done instantaneously. Those jobs, no doubt, are going to be under threat. But as Mark mentioned, there are going to be other opportunities that are created. But more importantly, I think what for small cap and how it's going to impact them in general is not just from that efficiency that these companies that are not in the software space, they're going to be able to use AI and increase productivity, but the amount of capex that's getting infused into it because the data centers and because the infrastructure needs to grow and the grid system and the taxing is going to take on the for electricity, and the cost of it is massive for some of these smaller players, and it's going to move the needle a lot more than it is for a large cap. Right? Some of these companies are going to double, triple, quadruple their earnings in a matter of 18 to 24 months. And that's where the opportunity exists, because in the first time in a long time, small cap is really going to have some earnings growth power here. And a lot of that is due to that AI effect. No doubt, there's going to be cannibalization as there is when any technology gets introduced. But I think ultimately over time, it's going to be a mass positive for the small cap space because of the investments, because of the efficiency that they're going to get out of it. And for us, it's just determining who are the winners and who are the losers. And that's where, as active managers, we can make that bet, unlike a passive vehicle, which is going to be allocating to pretty much a lot of the losers that we won't be allocating to.
Right. And also, what you mentioned earlier, the end of software, it's so consensus almost. But if you look back, it's like cloud wasn't consensus. Mobile wasn't consensus. So it almost feels like you should, back to the contrarian approach to the whole thing. It almost feels like that's the right way to go. All right, let's change gears and maybe, because as you know, this podcast, part of it is that we are trying to create this big white paper on the use of AI in the investment process. So, where is AI already like a real in your workflow today, even if it's basic, like, for example, it's just document parsing or, earnings transcript extraction or, alternative data hygiene, whatever it is. Like, can you just maybe, where do you use daily, or maybe not daily, but
Yeah, we do a lot. We do quite a bit.
It's an understatement.
Exactly. So, I'll start like this. I guess investing has always been about making decisions under uncertainty, right? And
Yep.
so if you think of it like a puzzle, you might be able to see a quarter of the picture, but not the whole thing. So the hard part is not access to information. It's maintaining discipline when narrative shifts, markets get emotional bias. And over time, Mara and I realized that, the edge is not AI. The edge is structure. And so I think for us, we built tools to help us impose that structure on our process so that we're not going to make a mistake when do we buy or sell this stock or whatever. We have the data that will give us, or we'll have to face the music of the data if we choose it wrong. So it's one of those things. So, we built tools to help us with, earnings calls. We evaluate the risks in the calls, and we also actually look to use the NLP to look at all of that and then do a deep dive on it and a forensic dive on it, so that we can actually understand the words that you choose to, and the Q&A really do matter. So for example, if we were to look at the biotech industry, right? And so that what that thing does for us right now, because it's so unique, the payoff structure is incredibly extreme, right? You could see a 30 or 40, 50% up or down move based on the outcomes because they're often binary. So the single clinical trial is important to that company. So here's the setup. The data sets that you get are often limited. Expectations can build quickly, obviously. Investors can start to imagine perhaps what the big bull case could be. And that's before the picture is even clear. So what we do is we separate the evidence from the enthusiasm, right? That's what we do. And then we anchor to historical success rates. And then we also make small adjustments based strictly on what is documented in the filings and transcripts that you can see from Edgar and the SEC. So that structure keeps us grounded, and it really helps us avoid being short-term swings, right? So, but here's the important part, and this is the key, and Mara and I were just talking about it earlier today, is we still do the fundamental work. We verify the potential market size. We assess how large the opportunity could realistically be. And, I guess maybe to sort of sum it up, structure around probability is one side of the equation. understanding the upside is the other, and we need both of them to be there.
Right. So if I'm hearing it correctly, in micro and small cap, which is full of narrative traps and too good to be true stories, you're using AI to reduce the narrative risk, not to amplify it, right? In a way,
Yeah, it's basically allowing us to look at and say, hey, we have a group of companies that have drugs that are going to be under trial. We can use. There's been some white papers about what the percentage of getting a drug approved in stage 1, stage 2, and stage 3, and then we use those, and then we add or subtract from that so that we can understand. Okay, the safety, the dose is so high that it's going to basically do bad things to the patient. So those types of things we can negative or positive it just as a thing. So we've built those little cues that we can use to say, hey, this probably might not work. So we're not going to buy that stock, or we might, go look for another space to.
Yeah, Nicole, when you think about it, AI is just technology. And we've utilized technology ever since we got into this business. I mean, if you go back in time, they didn't have Excel spreadsheets. A lot of stuff was done manually, right? Or they would draw charts using a ruler. Right? And then all of a sudden a computer came around and they could do a lot of stuff with back testing. It was amazing. And we did that too. We did back testing, and then we had our factor models perfected over time. And then when NLPs came about, we had the ability to kind of take this big data, unstructured data, and get it a little more clean and get a better sense of, okay, make it structured, understand what the narrative it is. That was just technology enabling us to get a better sense of what people were talking about within stocks. And now this AI thing, what is really helping us to do is making all of that way more efficient, right? Like I can upload a bunch of transcripts and get a report, a good SWOT report on a company that's not covered by any Wall Street analysts, and it's unbiased, right? It's biased based upon the data I put into it, but it's not unbiased. No, I know this AI, OpenAI with its Claude is not saying, hey, I'm going to spin the article this way because I have a buy or sell on it. It's saying this is it. These are the facts. And Mark's example with biotechs is a classic example of how up until recently, we had no way to analyze biotech and pharma companies because as fundamental managers, you don't go into space that has negative earnings, zero sales, because you just don't know. We don't have the technological, we don't have the PhD background to unearth which company is going to pass through certain phases to get FDA approval. But what we can do now with technology is say, hey, we got a bucket of companies that are phase 3. The probability of success for these companies is pretty high given their therapeutic disease that they're addressing with their drug. On top of that, we can make certain adjustments given the model that Mark has created with AI as an underpinning of it to say that probability of success increases because you know what? They're on time with their trials, right? Their applications are on time. They have the sales force. The CapEx is expanding. So now we've taken a list of 300 companies and narrowed it down to maybe 25, 30. And from there, that's where Mark and I was going to say, okay, what is the market potential? We know that the probability of success is high. Now let's take a bet on 5 to 10 of these companies. We were never able to do that 10 years ago, 5 years ago, or 3 years ago.
3 years ago, that's when we did it start.
Yeah, so that's where AI is coming into play. So again, Nicola, we've always used technology in our process to make what we do more efficient and effective. AI, agentic AI, whatever it's going to be, it's just another part of that process. But at the end of the day, and I think what Mark is saying, you still need somebody to make that decision. Because there's one thing, no matter how good AI gets, there's one thing it will never be able to do, predict the future, right? Yeah. And as long as it can't predict the future, you're going to need somebody to make bets on the future. And that requires portfolio managers like us, entrepreneurs, innovators, and a host of other individuals to take those tools and make those bets on the future.
Is there a, I don't want to say concern, with names with no coverage, you obviously have to roll up your sleeves. You have to read the transcripts. Let's say I'm going back like 10 years ago. You have to read the transcripts. You have to, go online, find like local newspaper or whatever, now with this kind of evens the playing field. Like you just dump a bunch of stuff into, something, and it's almost like, if you're I don't want to say a slacker, but like, it elevates the capability of somebody who might not have the greatest of work ethic. Like, is that a concern at all?
So one of our dear colleagues of ours back in the day, when we would have meetings, he would take our screens. Our fundamental screens are quantitative screens, right? And they're easy to do. Anybody can replicate them. Now there's software online, so you can pay minimal amount and redo these screens. And he would say, here, you could take this screen and build your portfolio. And you could take this screen and build your portfolio. And I'll take this screen and build your portfolio. And I can assure you that at the end of the day, over a market cycle, I'm going to have a different alpha than alpha you're going to generate. And that's because it does require a certain temperament that's honed over years, experience of understanding cycles. And it's not just, again, the technology tool, this AI tool will give you an illusion of certainty that doesn't really exist, because the market, again, is based upon humans making decisions. And ultimately, it's upon Mark and myself as portfolio managers to get ahead of those decisions and place the proper bets. And I don't care who has access to technology. The ability to outperform the market or generate alpha over market cycles requires a true skill and a true temperament that comes with time. Go, Mark. You're going to say something.
Yeah, I was going to say something. So, Nicola, do you know Ben Hunt?
No.
You should look him up. He has a product called Prism, and we use it. And so I'll give you a brief note on it, just because we were one of the first people to get it. And so we had this Prism program, which is literally all the news, all the earnings calls, social media, everything gets processed through his system into an NLP. And then we build off of that. So it is incredibly powerful. So now you're looking, and one of the things that we did back in 2022 was, the narrative was, it's inflation is transitory. Well, we all know today, but I'm pretty sure when we started looking at, we took all of our earnings calls, we brought them all together, and the one thing that we saw was everybody, 70% of that entire map was built around, we're raising prices. It was not transitory. And once that cat was out of the bag, we actually literally got started going and saying, okay, it's going to probably take us, a month or two to get it done. And so we started doing that, and we started getting to where we wanted to be in an inflationary regime. We had to get our portfolio to the regime as well. So that's the key. And, that year we put on 1,000 basis points over the benchmark. So these are real tested cases that we've done. And it's worked. And now we're able to go back and say, hey, let's systemize this. Let's get this going, and let's try to figure out how we can get signals and things of that nature. So this is pretty powerful stuff, which means for our business, again, this is the underlying issue. Are we going to hire a bunch of analysts? So that's the debate that's going on right now.
Yeah, the other debate is, and I heard this from a couple of people, the quality of the apprenticeship process, right? Like if everybody can now just, cut corners at the age of 23, 24, 25, as opposed to, doing the CFA and doing the direct indirect cash flow statement and reading the trends and, be getting excited over finding that, 2 sentences in a report that nobody else caught or something like that. So it's what are your thoughts on development of the new analysts? They're obviously all taking Python in school. They're obviously having introduction to machine learning and predictive analytics, etc. But the underlying fundamental kind of, scar tissue and experience in building that kind of mental history of events and experiences. Where do you shake out on that?
Well, so I think, what I was going to say is I think personally, I think it's great that they're starting to teach a method for individuals to adapt these tools and make them more efficient. But ultimately, the hardest part with any tool, as Mark mentioned a little earlier, is that filtering out the nonsense or the bullshit, as I said, from what they're giving you. Because there's been plenty of times when I've used ChatGPT or I've used Claude in Excel to say, hey, build me a model on this, where it, again, this illusion of certainty, where it provides you an answer that seems legit. And if you take that answer and build off it, your entire structure is weak. So if you can't spot these things earlier on, you might be wasting so much time building upon false information, which only leads to false conclusions. Ultimately, this tool will never be 100% perfect. And as individuals, I think we have to be better at critical thinking and skeptical when it comes to answers that are perceived as 100% correct, knowing that they're not 100% correct. And if you don't have that skill, you're going to be creating false assumptions that lead to false results.
Yeah, I mean, we can talk about this for a long time, but I think you synthesized it perfectly. So if you were to look at the applications of AI, and again, you have experience in this, but like just looking at the current um, viewpoint of AI investing, what is the most kind of overhyped element of it, and what is the most still actually underappreciated? Either one.
I would say the unappreciated part of it is the infrastructure build that's required, especially the energy intensiveness of it, right? That's the biggest issue, is that these data centers are going to drain a lot of energy. And that's not going to be alternative energy. That's going to be fossil fuels, dirty fossil fuels. And we have disincentivized these energy companies over the past decade, given where the price of oil has gone to post-COVID, given the fact that we were on this big kick of ESG and so forth, which has been detrimental because now there's a grab across the board, not just in, but all commodities. So copper, right? Massive supply deficit. Silver, massive supply deficit. I think nat gas and oil here in the U.S. is really hitting a peak supply standpoint, just like everyone talked about when I graduated college. Now it's actually happening, but no one's talking about it, which is the craziest thing. So for us, that is an unrecognized part of the story that this year people are waking up to, because silver, copper's running, but oil prices are still far below where they might settle out if there is this massive story that goes around the supply is challenged, not only domestically, globally. And think the fact now that we're exporting natural gas, which we never did before. So that aspect of it, I think, is definitely underhyped. I think, unfortunately, what's overhyped, and I hate to say it, is how they're going to monetize it to the everyday consumer. Which they haven't really figured out yet. And I think businesses will adopt it, and there is a place for it, no doubt. It's not. I don't think they're just building, bridges to nowhere. They're building. We will need it, but how does the everyday consumer consume this product is yet to be determined. Mark, anything you have to say about that?
Yeah, I was going to just say, if you think about it, for the utilities, you have to pay per peak spikes, right? And so therein lies the consumer issue, right? The consumer's like, well, this isn't going to be me. My father and my father-in-law and everybody else that's, older and done working, they're not using that, but they're going to have to pay that price. And so there's a lot of that going on as well. In terms of the things that are overhyped is, simple models where they're trying to predict something. I don't think there's any, real data on that they're saying, hey, I can pick stocks with this, or I can do this. But regime changes in terms of what's happening on, in the financial sector or the consumer discretionary sector, we have that data, and it can give you information on what regime you're in, which will then lead you to say, okay, we can back test that and then see what worked.
Yeah, no, and I think it's actually even taking a step further. There's a difference between a macro regime and a sector regime, right? You can be in a bull market and be in a destocking in a certain sector, and you just So yeah, I think, and so you're saying that that was the underappreciated part, Mark, right? That taking all this information and kind of clearly defining the regimes, because the stocks act differently in different regimes. Obviously, you mentioned 2022, 2021 as well. So yeah, we ask everybody this: like, if you were to design a perfect AI tool or system to support your micro and small cap strategies, like, what would it want it to do? Like, I'll just give you, like, would it detect more, like, behavioral dislocations earlier? Would it ultimately, like, stress test every story of your portfolio? Would it be, surface some unobvious risk? Like, if you could, what would it, like, is there one thing that you could?
I mean, I know what I would want.
In an ideal world,
ideal world. Do you want to tell me which stocks are going to beat earnings, which stocks are not going to beat earnings? Is that possible? Outperform, like, that'd be great.
Funny thing you said. We'll talk about this after the call. I was actually, like, I'm working with a group of 7 developers. It's a product that is blend. I'm just an advisor from a domain expert, being a former fundamental analyst, but they're building a tool that is actually classic kind of machine learning tool. The spine of it is a classic machine learning tool, but it's augmented by different elements of the generative AI. And I was just looking at it, they're being hitting about high 70s, low 80s% in terms of like calling the beats
That's
and
great.
misses. And it's obviously something that's a very difficult problem. There's management discretion. You can't, machine learning, pulling forward an order or like revenue. So that those things, but it's still like I feel like there's a way. Still if you look at the consensus, if you lay out all the analysts across the board for every stock, only like half of them are right on calling the quarter, right? So with all the proliferation of data and models and everything, why isn't it better? So I'm a more in a advising capacity, but it's we can talk about it later. But yeah, but I feel like that's ultimately like not only tell me if he's gonna buy and beat and miss, but what he's gonna do after. That's the hard part, right? Sometimes the stock beats and he goes down 20%.
Yeah. Yeah. Mark, do you have any ideas of what you would want AI to do to make your job a little easier?
I want the next 100 years of stock quotes.
Yeah. Again, Nicole,
That's all I need. That's all I need.
I don't think there's one ultimate thing, like one tool that can address all of our issues, because you're going to have to use different software for different various points in the decision making process, right? If anything, I would like to get to a point where I can trust the numbers that it's spitting out to me. It's particularly when I say, hey, in Excel, but build me a model. I don't want to have to go back and check, quarters and years. I want it to populate it, which you can download now with a fact set. But even that, there's some integrity issues there because of the data integrity issues over time. But nonetheless, I want to have confidence in the data that this AI tool is bringing me. And that's only going to come with time as they get better. And they will. There'll be a point in time where it'll be 100% spot on. But right now, it requires me to be a little bit more skeptical when it comes to some real hardcore fundamental data that they're giving me.
Yeah, I mean, the key to that is you have to have another AI system like Gemini or whatever to double check it for you. Those are things that you just it doesn't solve everything, but it absolutely helps. And again, when I do all my earnings call stuff, I spot check where it is. I look up the line and it's the exact same quote. So I make sure that all of those things are tight. And all the stuff we do with biotech is the same thing. It's just making sure that you get it right on that. And so, but again, there's probably going to be some, but there's ways to code it differently when you do that. So that's been the power. So like I was having an issue with duplicates and some things because I was rerunning things over and over again. And I had like 3 of the same one. And I forgot to put the code in that says, hey, no, we're not going to have it. We just ditch the other one and get the new one.
Are you using like Cloud Code and things like that, Mark? Or
Cloud, yep, and AI and Gemini and yeah.
Okay. So for actual coding, you're using them, right? CLI
Yes.
style, like okay.
Yes.
Yeah. Because I feel like there was I was at a conference. It was a Bloomberg and Cornell conference in New York. It was the AI in investment management, and it was maybe like 7-8 months ago. There was still big pushback on no, I can do it better, and like this is good for boilerplate and something. But I feel like November, December, kind of when the Opus 4.6 came out and 5.3 on the Codex, I feel like those voices have been quiet,
silenced.
So,
yeah.
I do visual studios, and I'm way more efficient than I've ever been with it. I mean,
well, you know what they call it now? I don't know. I didn't know this term was around until recently. It's called vibe coding.
Yeah.
This is fantastic. I think that's what Mark's been doing for a little while now. Vibe coding.
Yeah,
vibe coding, man. It's fantastic.
I mean, making a website from plain English. I mean, you can snip a site that back to your website story. You can find a website that you like and say like, just make it like this, but make it for an investment management company.
Let me just after this, I'll show you what I did. I walked out and I turned to my wife. I'm like, either we're heading into recession or this is going to be the best thing ever, because it's scary to think what I did in an hour with very limited coding knowledge on my end.
Yeah,
it's wild.
I don't feel. I think I feel bad for like Upwork and Fiverr, like those those type of stocks. Like that business model is broken. Yeah.
But that's the scary part. 10 years ago, these companies were disruptors. They're being disrupted, which is fascinating, because I don't think in our career we've seen this disruption happen so quickly. It happens over generations. We're seeing this within intergenerational changes, and that's the wild thing about it. And yet again, an entry level is going to be an issue, right? Entry level workers. But go ahead, Nicole, what you were saying?
No, I was going to say, but like if you take a step back and think it through, like back to like the recession and the market, like this is a margin expansion story for everybody. Because I mean, you are, whether you're an Amazon warehouse that's has high turnover, but you're not posting those jobs back because the robot's going to replace it, or your United Health said that they would hire 20,000 call center operators to do customer service before during the open enrollment, but now they're not because that's being replaced by an AI audio voice AI agent. No, it's not a revenue opportunity. It is for the cloud guys or whatever, maybe for Facebook or something. For the most part, people is, you can see that margin. It's kind of like 2020, right? Like everybody, if you're a good manager in 2020, you took COVID as an opportunity to clean house, right? Like it was like, okay, I'm going to shut down that I had in mind maybe in 3 years out. Everybody had peak margins on lower revenue in 21, 22, call it. So I feel like this is the similar thing, but yeah, tell me what
But I will counter with this. What's 2/3 of our economy here? 2/3 of GDP in the US. Like 70% of it, consumer. So what's the cost of that? I mean, ultimately, that's great. It's a margin story. It's fantastic. And I think it is for a lot of companies. But if it comes at the cost of the consumer, which is already, look, the consumer's stretched. We're in a K economy. There's a big portion of demographics that are struggling. And I'll show you some Google Trends here that were really eye-opening with like how to pay for rent, talking about resumes, how to, Chapter 7 bankruptcy lawyers, all these things are going off the charts. On top of that, the cash freight index is all-time lows below COVID, nearing credit crisis levels. So consumption at the lower end of the demographic, middle end of the demographic, has already been challenged for the better part of a year now because of the affordability, inflation issues, which aren't going away, right? So the real question comes down to, this is fantastic from a margin story, but do we cannibalize the consumer in the process? And in that transition period where we eventually adapt to this new reality, what happens to consumption power? And if that goes away, right, you have two things that need to happen. One, they get retrained on the spot and are able to readapt to find new jobs, or the government comes in and starts giving a universal basic income to everybody, which in of itself is inflationary and causes other issues, which that's a topic for another podcast. But nonetheless, we can't forget the second, third, fourth derivative that occur with AI.
Yeah. But the argument that the market is going to keep going, because of the margin expansion story, I can see that Wall Street and Main Street. Main Street, I'm worried, obviously, and what you said is stretched, but these large companies, and yourself, it's a big top 10, 20 names pull the whole index. Maybe not in your sector, but you've seen also in small cap in the indices too, like a $8 billion name gets trapped in there because it just quadrupled, right? But looking at the trajectory, I feel like it's and it comes hand in hand actually, Mario, because how do you expand the margin? What's your highest cost for most businesses is people, right? So you're gonna let people go, replace them with something like this or on the margin, and it can be, this is back to now like discussing the gap between rich and the poor and everything else. It's a whole different story. But yeah, I feel like the market is I don't want to say like it's cheap or anything, but I can see how it can keep running, right?
Yeah. I'm a little more optimistic. Yeah, I'm a little more optimistic. I mean, we don't know what the future is going to hold, right?
Yeah,
we can guess and we can see this, but you don't know. Maybe there's going to be another industry that pops up out of this. You don't, again, I'm cautiously bullish, but I would say that if you think about what the future is going to hold, we don't know. And there can be more jobs being created. Now, again, that doesn't mean, again, for this, it's hard to talk through because I have no data for it. It's easy to point out all this data, but they said the same thing about the PC in 1999 and 1980. Everybody's going to be fired. Everybody's da. The mainframe is still the mainframe. All of that, and all we've seen is just better and better and better and better. And everybody has seemed to, not everybody, but there are challenges, and there's been challenges before. And so I think that there is a portion of me that says, but yet there's other people that are going to be innovating something else, perhaps. And so that would be my final talk on sort of chat on that, just because I think there is an upside potentially.
Yeah,
no doubt.
Yeah, guys.
Well, thank you, Nicola.
Mario, this was excellent. Yeah, thank you so much for joining. And
this was fun.
We will be Yeah, excellent.
Yeah. Awesome. Thanks, Nicole.